This is Maestro Minute, the show that discusses all things real estate, sharing interviews with the most successful people in the industry. Hear from their perspective and what they are doing to achieve success. Get exclusive tips on how you can also succeed in real estate. Maestro Minute is brought to you by Maestro Development. Here's your host, Nareg Muradian.
What's the difference between investing in a syndication versus investing in a real estate fund, like a REIT, right?
Yeah. So syndications tend to be you're investing in one particular property. If you have a real estate fund like a real estate investment trust, first of all, if it's publicly traded, the returns closely track what the overall stock market is doing. So you're really not diversifying your investment.
Why is that? That's interesting. I didn't know that.
Yeah, if you track it, I mean, it tends to track with the overall like S&P.
Interesting.
And then the other thing is you're investing in a whole portfolio, and you have no selection. It's up to the REIT or the real estate investment trust or the fund to decide what's going in that fund. And so you're not able to cherry pick, I like this property, I like the strategy and the returns for this particular property.
And are the returns greater on syndication, or it again just depends on the asset?
They tend to be, well, I think it depends on the asset, the investment type, but I think if you look historically at historical returns for REITs, they tend to be lower than the returns that we've been providing. So I'll give you an example of one of our recent exits. Last November, we sold the property in Kansas City. It was an 80-unit apartment complex, and we held it for 3.5 years. Our hold period was 5 to 7 years, but because we could meet or we could significantly exceed our projected returns earlier, we sold it earlier. So we sold it in November. The average annual return that the investors got was 21.5%.
That's an amazing return, right?
Yeah, it was very good.
For a REIT, you're not going to get that.
No, you're probably looking at maybe 10%, 11%.
Yeah.
Now, I don't know what kinds of tax advantages you can get with a REIT, but with us, there are significant tax advantages too. So when we buy a property, we'll do a cost segregation analysis, and that gives us the ability to accelerate the depreciation tax write-off. We pass all of that on to the investors, pro rata based off of their percentage of the equity investment. And so it's very typical that the investors will get distributions every quarter. And then when they get their K1 tax return, it'll show a nice paper write-off, so they can take that paper tax loss and apply it to this investment and other investments.
How do you see the investment strategy changing, with the economy where it is today? I mean, nobody knows where we're heading.
My philosophy is if you stick to your underwriting guidelines and you have certain returns that you're trying to achieve for your investors, if you can find a deal that meets those returns, so we're targeting 8 to 9% cash on cash return while we hold the property, 16, 17% average annual returns when you factor in the profit on sale. If something pencils out delivering those returns today, I think you're setting yourself up for a really good potential exit if you're exiting in 5 years. And the reason I say that is I think interest rates are topping out right now. I think the Fed's paused. They may not raise rates again. It looks like, we're starting to see deflation in some of these key metrics. And so if the Fed isn't going to raise rates, there's discussion about when are they going to start lowering rates. I think the discussion is maybe sometime next year they'll start lowering rates. So if that happens, when we go to sell in 5 years, in all likelihood, interest rates are going to be lower in 5 years than they are today, which means cap rates are likely going to be lower. And the value of the property, everything else being equal, is probably going to be higher. So it sets itself up for a nice exit down the road.
That's a positive, definitely a super positive outlook. And, in housing and healthcare, we do a lot of work in those environments, and I feel like I don't know, maybe it's because we're here in Los Angeles, but like there's never enough adequate housing, right?
Yeah, it's a nationwide problem.
Right. And affordability is huge. Do you ever see any piece of the asset or affordability coming into that? Have you guys ever looked at that?
We have like 20 to 25 different metrics that we're looking at when we're identifying a market, and then within a market, the submarket and neighborhood. And one of those is, what's the cost of housing? One of the reasons we're not in Memphis, for example, is the cost of housing is so low. It's very easy for people to buy a house. It's very easy for them to rent a house for at or lower what the rent is that you want to get. And so because of that, you're not getting a very high renter class.
I see.
So we like to go into markets where, the housing is relatively expensive. Not like California,
sense,
but
yeah.
significant. What the mortgage payment on a new home would be needs to be significantly more than what we need to get for the rents.
Thanks for tuning in to the Maestro Minute podcast. Make sure to rate this podcast if you found it helpful, share it with a friend that could use it, and follow us on all major podcast platforms. The Maestro Minute, powered by Maestro Development.